Good afternoon, everyone. My name is Rada Milanovic, the Director of Investor Relations at Ginkgo. We appreciate everyone joining us here today, and we're just going to give it another 30 seconds before we begin. All right, I'm showing 12:31 on the clock, but yeah, thanks everyone for joining for Ginkgo REIT's third quarter update. Today, I have with me two other colleagues, Principal and Co-CEO Bill Green, and our controller Eric Stamp. In terms of just a rough agenda, we're going to be discussing the current market environment for real estate, our performance, and some updated financials. We're also going to touch upon some new opportunities that we're seeing in the market, and we want to make sure that we're leaving some time at the end for a Q&A. So make sure to drop some questions in the box below. And just as a reminder, the webinar is being recorded. So if you miss anything or can't hear anything, we'll be hosting the webinar on ginkgovest.com, and we'll send out an email to all of our community members to notify you that it's been hosted. So that being said, I'll advance the slide and I'll kick it off to Bill.
Thanks, Rada. So as you can see on the first slide, not a lot has changed over the course of the quarter. You have short-term interest rates still abating. One thing, though, at least relative to the market overall, is the regulatory environment has actually gotten a little bit more decent in North Carolina with some legislation recently. But the biggest thing right now is the consumer's definitely stressed with inflation overhang. There's not a lot of spare cash, but you're hearing a lot of headlines that Thanksgiving is cheaper this year, et cetera, et cetera. So the inflation seems to be definitely moderating. For us, still, our rental growth is slow, but we have slightly improved collections, and we'll get into that in a second. But we still are fighting supply issues in a couple markets, predominantly Charlotte and Raleigh. But that's kind of really offset by cap rates going somewhat just a little bit higher, but they're definitely plateauing. The question we get asked a lot is Western Carolina storm damage. We had no direct impact on our portfolio whatsoever. It was very, very spotty in the mountains where it was bad. It was extremely bad, very adjacent to rivers. But once you got past that, it really, you almost, even within a day or two, if you weren't in that path of the flooding, you actually almost didn't see anything. And so overall, even though it was horrific when it happened, and if you got affected directly, it was awful. For the most part, it was relatively modest. So what's really going on, though, on the next slide, you'll see we have this very interesting boomerang that took place, and so inflation's coming down, and the market really prices that in, and there's an announced cut in rates, and so those rates are coming, they're coming, and then in September they go ahead and they cut rates, and now you've seen this super quick boomerang, and that's the boomerang in 10 years. And so if you look to the next slide, what's kind of interesting is with interest rates, again, the government only controls short-term rates, but then you have this 10-year treasury, and generally the 10-year treasury is somewhat in accordance with inflation. It's a little bit above, a little bit below, usually 50 to 100 basis points. And so you can see is in 2023, since this had sort of boomeranged on things, we've actually had rates that have been, now they've really escalated to almost 200 basis points. And what that really indicates is that either everybody doesn't believe that inflation is over, or there's somehow perceived risk in government debt, but people are actually asking for some of the biggest premiums ever relative to inflation. And so I don't really know what to say beyond that, other than it's an interesting place. And so our long-term market is caught up to our short-term market, and the market's going to pivot. With it, our market dynamics on the next page it's kind of interesting. our workforce housing, they're still evidencing, rental growth. Interest rates are stabilizing. We do have some inflation lingering, but for the most part, when we look at this, we look at our whole portfolio. So when we do our financial reporting, which are GAAP, we're going to start to present things in a little simpler way for you going forward, which will show you how we look at it. But for the most part, the rest of our expenses and everything really came out pretty decently. So when we look at our entire managed portfolio, so roughly 7,000 units on the next page, what you see is the following, and that is, these are year-to-date numbers. Units go down a little bit. This is through October. The revenue's up 6.7%. That's even with slightly higher vacancy and still fairly high collection losses, but it's improving. Our expenses went up a little bit more than that, but our net operating income went up, really 5.7%, which was terrific. Our recurring CapEx, and a lot of our capital spends really came a lot more in control. The shortages and everything associated with the whole chain and the supply chain actually came a little bit better, and we actually have had very nice expense control across the portfolio. So as a result, our net cash flow is up 8.5%, but our interest expense is going to continue to creep up for a while as our short-term rates burn off. We have to put longer-term debt on or replace them. That is going to continue for the time being. But our net cash flow actually went up. Our property level interest income went up. And so overall, we're having a fairly good first half of the year and first really 10 months of the year compared to last year. When you compare that, what are the elements that are associated with that is our occupancy trends are shown on the next page, and they're a little bit wavy. But for the most part, they're really behaving within a range. What's an outlier for us right now is Columbia has been doing fairly well, but that's just a single asset. So we have other assets in the portfolio that are 96 to 98%, but the rest of these are pretty much paired around 90 to 94%, which really ties to those markets. For the most part, those markets which had been around 94 to 95% prior to COVID and during COVID, with the supply that's come online, everything's about 2% more vacant in these markets. Additionally, our rent trends, though, they're still going up. So if you look on the next page, they're not huge, but our same average rents rose by 3.5%. Our total portfolio average rents went up 4.4%. And usually that total portfolio average is skewed by when we're renovating units, et cetera, where our average same store may not have as much renovation going on. But again, we're seeing kind of the same trend in each market. Each market is doing fairly well. Although Charlotte had a very nice uptick over the course of the year for us and was slightly our best performer. With it, our leasing trends remain pretty solid. Our trade outs, the upper left-hand corner here is just kind of, here's what our average for all trade outs. So basically somebody coming out and coming in, and then our average renewal is up also. But what's an interesting thing is, as you look at the course of this year, and this has been a little bit unusual, the rents we're getting from outside new tenants get discounted. You're making a bet really on what's the percentage of people that are coming in. But our average renewal rates are actually slightly higher right now than our average trade out rents. What can also skew that, though, is generally our renovated units tend to trade out more frequently. So the absolute amount of rent you can put there is closer to the top of the market. But where our average renewals can oftentimes be people who've been in residency for a longer time, and they have maybe not as renovated apartment, or their rent is just trending below. Our discounting is up a little bit year over year, but for the most part, it's doing okay. And we're really working hard from COVID to actually get people a little bit better experience, and that is, our average work order days, which gets fairly skewed, it's still 50% better than where it was at the start of 2023, and it had gotten a very bad level during COVID days, unfortunately. But with it, rent collections have also they've started to moderate to a very tight range. And if you follow those little black dots, which is the poly of the whole portfolio. So it's the average of the whole portfolio. And I never know what poly means. Everybody likes to use that term here, but I'm never sure what the poly means after that period. But what you can see is basically the arc is starting to come down. And so on a monthly basis, we're starting to see better collections. And we've actually had some very fairly interesting things happen at a couple properties where we've had over 100% collection for a couple years, a couple months in a row as we've been collecting up. With it, from the REIT perspective, and this is really just taking the prior part of this presentation and saying, all right, here's the wholly owned assets, and then here's the JV units. We're seeing a somewhat similar thing, other than in the wholly owned portfolio, we have a concentration to a single large asset that is a little bit of an outlier right now, and that is it had revenue and occupancy down year over year. That is starting to increase, and it's coming back, but so far it's kept us kind of flat on our net cash flow. Where you can see in our JV portfolio, we're up to, we're up fairly, we're positively, but when you actually throw the interest income in, we actually end up in a better spot. And you can look at it this way: our interest expense is going up, and so our interest income is actually going up. It's not fully offsetting that because we have more debt that we owe than we have cash on hand, but it is actually telling a fairly good story for us at this point. So with it, fourth quarter for us is we're trying to do a strategic deal and buy out some joint venture interest. That's in progress. It is not complete. It is still in negotiation. We do expect to have a net additional 850 potential units in that in 2025. But our big goal over the next really 12 months is to take our current ownership, which is currently 32% of our physical units are wholly owned and 68% are JV, is we do want to try to round trip that and make it a 60-40. So 60% are wholly owned and 40% will still be in JV. And I think it will give us all it will give us the return we want. It'll take a little bit of the volatility out of a single asset that might be offsetting that. So I'm going to turn it over to Rada now and let him talk a little bit about the capital markets and where we are in our capitalization.
Great. Thanks, Bill. Just want to remind everyone once again to post questions in the Q&A box, and we'll get to them at the end of the presentation. So yeah, on the debt side, it's a little bit of a challenging environment. We've seen 2 rate cuts this year, the latest in November. The Fed lowered the target interest rates by 25 basis points to 4.5 to 4.75%. And as Bill alluded to, surprisingly, we've seen a pretty significant uptick in the 10-year Treasury. So it's been 85 basis points movement in the last 2.5 months, so sort of an inverse correlation. And with our consolidated assets, we're set pretty well. We don't have any principal maturing until 2027. All the debt on the consolidated side is all fixed rate. In terms of some data points, the average maturity is 4.8 years with 4.5% fixed rate. On the right-hand side of the slide here, you'll see our unconsolidated assets, and we're continuing to work through those. And what that means is that we're actively evaluating options to purchase new rate caps or potentially refinance debt with fixed rate mortgages. And to add and enhance some liquidity, we recently spun up our Ginkgo Notes program. We, in the past, have had a line of credit which had I would say, reasonably high unused commitment fee. So we looked at ways where we can engage with our investor base and provide them with some new investment offerings, and thus Ginkgo Notes were born. We wrapped up our medium-term notes, which was a success about 2 months ago, and we're currently live on in the market with our short-term notes, which I'll touch on in some of the subsequent slide. We recently brought on a director of asset management who's been leading a lot of the conversations with existing lenders, but it has also been broadening our relationships with some of these banks. And the key takeaway here is that with a lot of these conversations, we're seeing the most attractive pricing in the market at a 5-year fixed rate. Also worth noting here is that earlier this month, Fannie and Freddie released their updated multifamily guidelines, which the FHFA has recently increased agency lending limits for 2025. That certainly bodes well for Ginkgo since we do work a lot with the GSEs here. Another thing to point out here is our debt is meaningfully lower than the spot market, which certainly helps lower interest rate expenses. So where do we go from here? So we continue to sift through acquisition opportunities, both through fully marketed deals and off-marketed channels. However, in the last 3 to 4 years, it's been hard to find deals that pencil out. As a good data point, in the last 12 months, we've looked at over 200 deals. We've underwritten about 50, and we've issued about 20 LOIs and only bought one deal. But that said, we're starting to see cap rates exceed debt yields. So, what that means is we're starting to see positive leverage for the first time in years, which is you're in the commercial real estate space. This is sort of what you want to see, or commercial real estate 101. This is the green lights come on. We're also having thoughtful discussions with some strategic partners that might want to provide some discretionary capital or programmatic capital sources. And lastly, we've seen a lot of good activity with our new online investment platform, GinkgoVest. Just as a reminder, not only is GinkgoVest an online investment platform, but it also links to our backend. So investors can check out their investment account, see their tax documents in the future. It's also a learning center as well. We provide blogs on real estate topics if folks are not familiar with investing in real estate. This webinar and future webinars will be hosted on GinkgoVest as well as some investor testimonials. And last I checked, we were getting about 1,300 hits per month. So we encourage everyone to visit ginkgovest.com and provide your feedback. On the capital formation side, we have some exciting opportunities. We've exceeded our target raise on our medium-term notes a few months ago. Therefore, we're back in the market on short-term notes. And just for a reminder on Ginkgo notes are unsecured. However, they're backed by the parent company, Ginkgo Multifamily OPLP. This latest batch of 6-month notes, we're offering $2 million, up to $4 million if we do achieve that threshold. The base rate is 6.43%. We're offering yield enhancements at 100, 250, and $500,000 increments, with sort of the upper tier being 7.18%. Interest is accrued. You'll be paid the principal and interest at maturity, but we are planning to have future notes be coterminous with maturity, so you can roll that investment into future notes offerings, sort of see the benefit of compounded interest there. We'll also offer a simple 1099 tax document at the end of the year. And we're taking orders through ginkgovest.com. If you go to the offerings page, you'll see a notes tile there. We're in the final stages of preparing the documents for our short-term notes, which should be any day here now. And just as a reminder there, our closing for the notes is December 19th. And we also have our last closing of the year for our REIT. That's scheduled for December 1st. So for folks that are looking diversification, income, and potential upside, Ginkgo REIT checks a lot of the boxes. As Bill alluded to, the fundamentals of workforce housing and population migration certainly remains strong, and don't want to steal Eric's next couple slides here, but the performance has been exceptionally well compared to some of our peers. So yeah, with that being said, I'll pass it over to Eric Stamp, who will discuss our net asset value and some key performance indicators. Eric?
Yeah, thanks, Rada. So yeah, we'll kind of go through what our pricing looks like, what we've historically seen, and then kind of how we're benchmarked against some of our competitors. Over the past year, we have taken a look at with the board, kind of worked together and created a new written policy for what our valuation looks like. Governing what the principles, policies, procedures. With the overwritten goal of just establish a consistent, transparent methodology that doesn't transition too much from one quarter to the other quarter. We're looking at the same inputs and just kind of evaluating where the portfolio is going. So it's a little bit more responsive to both our own internal forecast, but as well as external factors. So with that, the board kind of looks at a handful of different things, right? When they're reviewing their policy. One is they want to see what the new quarterly evaluations look like from our independent appraiser, some of the inputs that go along with that, what their forecasted cash flows might look like, what cap rates kind of look like, and then kind of benchmark that against their own experience plus what they're seeing in the market. So they look at that. They look at a consideration between what we're doing internally forecasting, what the appraiser's forecasting, and seeing what the differences look like. Some of that is related to the way we look at forecasts from both the historical and forward movement and comparing the two. And they also look at what they see on what we're planning on the capital planning and expenditures side of the properties, whether that might take into account some additional vacancy for value add projects or what they expect to see just from a capital outflow and inflow moving forward on those. And then lastly, they kind of take a look at some broker opinions of value just to kind of monitor how those look against our appraisals. Most of the time, broker opinion of values or BOVs are a little bit more forward thinking. So they take a little bit more of a forward approach where appraisals look at both sales history, historical operations at the property, and just kind of monitor the difference between the two. So with all that, kind of what we expect to see going forward is a little bit more of a minor adjustment going quarterly to stock price, where historically we've kind of looked at it over a little bit longer period of time and evaluated, where now we expect to see some minor adjustments, whether it's $1 or a couple of dollars, generally anything under 5% to the stock price, unless there's some large external factor that causes disruption that would be outside of our control. With that, at the end of the day, we're still not a daily NAV REIT. We don't expect to be. We don't trade daily. We aren't marked daily. So the overall goal, the overall attractive factor for both the board and management is just to truly find what the long-term intrinsic value of both the company and the assets are to mark the stock price. So with that, the board convened last week and have marked down the price from 141 to 136 effective today. With that, and we'll go into a little bit more detail in the next slide of what has transitioned over the past year, what the drawdown looks like, and kind of what we've seen over the past 4 or 5 years, and expect to see going forward. But with that, the dividend remains the same. So the yield will uptick a little bit to about 5.6%. And overall for 2024, we've seen through this effective stock price change about a 1% decline in total return. The $9 drawdown is offset by our 7.5% dividend. If we go into the next slide, we kind of take a look at what we've seen and what the visualization of what our portfolios looked like over the past 4 years. This whole slide just includes the same property portfolio. So that's 65% of our portfolio, but that represents any community that's been owned for the entirety of all the 4 years. So this is a direct comparison of everything that's been incorporated for the past 4 years. So it eliminates any noise for any acquisitions, dispositions, or anything that we've had outside of this subset. Again, 65% of our portfolio since 2021 is same portfolio or same property. So it's a healthy representation of what we have in this group. As some of you may know or have been part of it, the REIT for a while. In 2021, we had a pretty large expansion and acquired a lot of the Ginkgo legacy assets that were held in like single asset JVs, and we acquired those. So in 2021, there was a big uptick of over 2,200 units to the portfolio to where we sit today. So this here, we could kind of see, or the graph illustrates kind of the inverse relationship we see from where we've been the past 4 years, appraisal wise, and where our cap rate has gone from the past 4 years. So you could see over the past 4 years, we've actually had a 20% increase in NOI, yet our valuation has remained flat. Again, from 2023 to 2024, some of this is related to cash flow management, NOIs. We've had very minimal growth, especially on the consolidated side. The unconsolidated group has kind of upticked and helped balance that out. But primarily over the past 4 years, you can see here, our flat valuation is most correlated to where rates are and kind of where we continue to see the most struggle in maintaining valuation. In late 2023, especially for some of our larger assets, forecasters from the appraisal side had a lot of market downside where we just weren't seeing the same inflation factors or impact factors we have historically seen. So appraisals came down with forecasts of cash flows a little bit lower than what we would have historically seen. So the past 12 months, we're trying to catch up here. And what we've actually seen is for the past couple of months, especially leading into Q4, we've actually already seen an uptick of what the properties are already generating versus what the forecasters put into the appraisals about a year ago. So we should be able to see some of the uptick coming in the next couple of months, especially by the time we do our next valuation. The last thing, two things I'll say here is some of this that's kind of underlying that you don't really see on the front surface of this illustration is that, and Bill alluded to this a little earlier in the presentation, but some of it is related to the underperformance of two of our single largest assets that just create a very high concentration within those assets. Over the past year, we've seen about a 10 million decline in valuation, which is about a little over or a little under $10 a share. 6 million of that we've kind of already inherently incorporated over the past year, but the last 4 million kind of got incorporated into this quarter when we got new valuation. So that's about a $3 impact of the $5 drawdown we saw this quarter. And then lastly in here is that this doesn't take into account what we expect to see on the JV level side. Again, over 60% of the physical units are owned through JVs, and a lot of those have underlying promotes that can be captured through increases in cash flows or a decrease in rates. So there's kind of a couple mechanisms that we can get to getting that potential and outsized returns. Any further drawdowns were at those JV levels just at a pro rata amount. So it's significantly less influence than when we actually see an increase in cash flows or a decrease in cap rates. So we definitely have a lot of outsized performance possibilities if those JVs just increase cash flows by our regular 5% going forward, and we see a little bit of drop down in rates where we can access those promotes. Rada, we can move to the next slide here. So one of the other things we continue to do and we'll continue to monitor is how do we look against the other guys. For the public non-traded, I'm sure a lot of you are familiar with some of these. They're the largest players in the group, especially Blackstone and Starwood, and kind of where we've looked over the past 5 years since our inception. The past year, we're a little bit down. Most of it is just our catch up of the drawdown and what we've seen in rates and a little bit cash flow wise. But mainly the last year has just been our catch up and our valuation of creating what we think is the true value today. Again, a lot of that is offset by our dividend. But over the past 5 years, we significantly outperformed all of the players in the non-traded space or the multifamily space. So again, we continue to see that there's a lot of upside, and we think this could even increase by early into next year as we capture some of the JV level promotes, and as well as some of the recent flows corresponding to some of our lower performer assets. Again, on the next slide, we'll kind of do the same thing. We kind of compare, benchmark ourselves against some of the other smaller players of the public space. Again, as you can see here, there's a lot more volatility that's happened over the past couple of years. Again, the idea here and the 100% of our dividend has been tax sheltered, since inception in 2019. But to creating, long-term capital appreciation, but through a mechanism that doesn't cause this type of volatility to investors. One, it'll help preserve health, wealth of our investors' money, and two, it's a little bit more of a stabilized investment investors, go through their hold period. Again, over the past year, the public market is reacting to a lot of the news type stuff that comes out. So we're going to see how that stabilizes over the next couple months. But again, as you can see through here, over the past 5 years, we continue to outperform almost every REIT in the public space. And the last slide here will kind of show a list of all the other public REITs that we benchmark ourselves to, pretty much every multifamily REIT in this space. Since our 5-year inception, we've outperformed almost every one except for Independence Realty Trust. They had a large merger acquisition about 1.5 years, 2 years ago. So we'll see exactly how they kind of normalizes some of that plays out. But again, still over the past 5 years, the REIT's done exceptionally well. We've outperformed all of our counterparts, both in the public and the private non-traded side, and we continue to pay a high paying dividend yield. Today it's 5.56. Realistically, with being 100% tax sheltered over the past 5 years, that's closer to a 9 to 10%. So there's still a lot of growth and a lot of potential that we see in the portfolio today, and especially if rates just cooperate a little bit on our side. There's a lot more upside than we'll see downside, especially as we have more access to the JV level promotes than we would on any downward correction. That's what I have going through there. So I'll go back to Bill.
Thanks, Eric.
To close this out.
Thank you. So where we are right now is we actually see a good opportunity right now to go ahead and complete the purchasing of JV interests. Obviously, these are at new cap rates, et cetera, where we expect the transactions, if successful, to be immediately accretive to NAV. But we also do expect that short-term rates will drop below long-term rates, probably sometime in the next 6 months. I never actually foresaw that the long-term rates would actually expand as much as they did. That this would be a little bit more led by long-term rates going up and less by short-term rates coming down. But nevertheless, getting to a positive yield curve is really important for real estate and real estate valuations. And so I do expect that to happen. If things kind of trend where they are right now, that's fine. But basically, I think short-term rates they're modeled to get less than 4%. But even if they hang out at 4%, that's not the end of the world. But as long as it's just positive, then you're making long-term bets with long-term money, and you're making short-term bets with short-term money. But for the last 3 years, it's been an unusual situation where making a short-term bet is a big bet, making a long-term bet is a big bet, and we've been unwilling and unable to figure out how to do that properly. But for us, we're looking at the same information that you are, and we've always tried to benchmark ourselves against the market. We've always tried to benchmark ourselves against the non-traded market, and on a performance basis, we're over a long period of time, we're doing really well. We're doing extremely well against the non-traded space, but in the public markets, obviously, public markets always they react to news first, where the non-traded space is always it's valued off of underlying asset classes. So the big run up in value that really took place really in the last, I would say, 4 months of the year for the publicly traded multifamily REITs. And that should be a good harbinger of where capital flows might be going again in the future. Generally, the public space leads what the non-traded space is. And so I look at it like this, and we look at it like this, and that is, with this reduction in price, and with the warrants program where you get 1 share for every 10, we're actually going to go ahead and make another investment. And we have a substantial holding in the REIT already, but we are going to go ahead and make an investment into the warrants and the unit program prior to the end of the year at 12/31, I guess, for a really simple reason. That is, we're effectively, with the warrants, which will expire after 12/31, you're effectively able to buy the stock for a net price of 122 and 122.4, which is north of a 6 cap rate. So basically, I know I can't buy anything in this market right now at a 6 cap other than my REIT. And so we're going to go ahead and put some money into the REIT in expectation of further long-term accretive cap rate alignment again. And that's kind of it for right now. So thanks, Radha and Eric, for your comments. But Radha, if you want to go ahead and either read comments or open it up for questions.
Yeah, thanks, Bill, and thanks, Eric, for your commentary and your presentation. I'm just opening up some questions that we have here from some of our participants, and I guess Barry asks, "What's LOI?" Maybe he's alluding to the fact that we had submitted a couple LOIs on opportunities that we saw in the market, but were outbid by folks that had higher prices or were out-of-state buyers potentially. Looks like the next question from Bill
Barry, just to be
Strebe.
specific, it stands for letter of intent. So it's a non-binding. It's a non-binding engagement that's common in multifamily and all real estate, where you tie up a transaction under letter of intent, and then you get a brief due diligence period to make it into a contract, after which, after the contract is in place, there's typically another 30-day or 60-day period to do all your confirmatory due diligence to see whether you're going to go forward. So the LOI is the first step.
Yeah, that's a great explanation, Bill. It looks like Bill Strebe is asking, has the valuations of properties stabilized, or do you see potential risks?
We always see potential risk, but what's interesting is, even with these cap rates, I'm going to say, and I could be a little bit wrong on this, Eric, but I want to say over half of the portfolio year over year has values that are higher based on their cash flows, and so the appraised values have. But we've had a couple fairly big ones that came down pretty substantially, and it is we for the board and for other things we discuss, kind of, here's what the company looks like net of the performance of these two assets. But that's sort of disingenuous too, because if we go back 3 years ago, they were the best performing assets, and we didn't choose to do it then. But what it did highlight was why we need to get more on balance sheet scale, as opposed to minimal ownership of directly owned assets versus joint ventures. So overall, we're still seeing positive trends across the portfolio on rent and bottom line, but that doesn't mean that cap rates aren't going to expand further. We don't control that.
Yeah, and the only thing I'll add to that as well is that the methodology that we have for valuation too is it already incorporates a lot of any changes in cash flows. Again, we generally look at it from a balance of what the forecaster or the appraiser is forecasting versus what we've internally already had happen for the past 6 months and what we expect to happen for the next 6 months. So a lot of times, in most of the cases, when an appraisal comes in, especially if it does come down below value in the other appraisal, it's already been marked into our valuation. So we're not taking, a 1-for-1 direct hit. A lot of it's already been built in. Usually where we would see it is any upside, because again, we're looking at it from both a historical and a forecast model, where the appraiser will be looking at it just from a 1 year forward. So we generally see a lot more on the upside when appraisal comes in higher than what we would actually experience if appraisal does come in less than what it was the last time we got it appraised. So I do think that helps monitor some of our risk of what's already been taken into account for valuation.
Yeah, historically, our value has actually been about 10 to 12% below what the
Yeah,
combined total of the appraisals are.
yeah. So we definitely have a lot of cushion if appraisal does come in below. It helps just balance the portfolio out and monitor that risk.
Thanks, Eric and Bill. I'm just seeing another question pop into the chat. Which two large assets performance declined and why? Maybe if you can expand on
Yeah,
those two
there are two
assets.
assets in there are two assets in Greensboro, North Carolina, or Winston-Salem, North Carolina. One's called Glendale, the other's called Garden, and it was a combination of two things. One, that market and that asset in particular had very stable collections, kind of throughout COVID. But I would say tenant advocacy plus really a slowdown in the court system has led to a much higher percentage of really long-term non-payment. So where historically and in most markets we started to drift back about 30 days from a historic 30-day eviction process. Pre-COVID, it went to a 60-day eviction process, and then really a 90-day kind of average collection process in certain markets. Winston-Salem and these assets in particular had really stayed below that until really the end of 2023. And the end of 2023, through again some government-sponsored tenant representation and legal aid, and some other kind of just general slowing of the court system and their inability to really maintain what they call a bond system, an appeal system within state guidelines. Our delinquent rents and our write-offs went from a historic 1.5% to almost 4.5%. So that's actually started to abate. And a lot of that was really big payers that had big balances. But when it started, it was like an avalanche of a lot of things that started, which we had seen in Charlotte, we had seen it in Raleigh, and that happened actually really during COVID and after. But this market was a little bit late to the dance. And so all that really happened in many regards is it sort of caught up with what had become the new customs in all these markets. And so now we see that starting to abate. We see that we see our occupancy getting back to where it has to be. We're seeing our collections improve on the margin. And to put it in perspective, as Eric said, $3 a share of the markdown this time was them, and also $2.50 earlier this year when we took a $4 write down was actually those two assets. And it relates to, really almost $700,000 of total NOI diminution year over year, and from our forecast, which is on a $7 million rent roll is a lot. We like the
Great,
assets though, if anybody cares. It's been a good asset for us. And historically, from when we bought it and into the REIT, I believe it's if you look at the value we paid in 2019 on a cash basis, we own it at like an 11 cap. It's been a very good performing asset for us.
Yeah, thanks for that explanation, Bill. And not seeing any more questions, but we'll give folks another minute or so. But also want to call attention to we do have our contact information on the screen here. So if you do think of any questions after this webinar or throughout the end of the year, feel free to reach out to myself or Bill or anyone from the investor relations team. Yeah, I guess with that, want to thank our panelists, Bill and Eric. Also want to thank our attendees, and maybe I'll probably kick it over to you, Bill, if you have any departing thoughts that you want to leave our attendees with.
No, just like happy holidays. I wish we had a different message today. It is what it is. I still stand by our record. I think our goal was always to provide access to a different niche of the multifamily market, and that is workforce housing in the Carolinas, which we think still has really great potential for outperformance relative to the generic multifamily market, and we still think that's true. We think like many markets, we're fighting some of the same issues. We're rebalancing our debt, et cetera. But I would say the last 90 days, really 6 months, It's been more a catch up of cap rates and appraisers than anything else. We're actually having a very good year again. So that's that. But give us a call. Love to hear from you. And again, happy holidays.